Hey guys, Dave Keller here with Market Misbehavior. Happy Friday, November 21st, 2025. Welcome to the show. We're coming to you from a kind of classic fall day here in Redmond, Washington. Our heat's out in our house, which is why I have a hat on. That happens occasionally. The good news is our upstairs, which is where I do the show, we have a separate heating system that we installed because the upstairs was not the temperature we ever wanted it to. And it's mostly been annoying until this day when all of a sudden I realized I can go upstairs in my office and just be perfectly comfortable. So, guys coming this afternoon, but that's where we're at. I appreciate all your kind and supportive words about how I'm feeling. I'm taking it easy. I promise. I'm trying not to do too much. Although as an entrepreneur, that is not easy to take days off. It's not easy to unplug mentally from all the things you know that need to get done to keep the business going. So I appreciate whatever patience you have for me and needing to pause a recording for a cough or two. I'm thankful. But thanks also for the suggestions about how to get better. I'm hitting the herbal tea, all the things. We'll hopefully, fingers crossed, we're better soon. So market, nice recovery day. We talked about that on Thursday's show. I mean, listen, there are days when there are weeks when I feel like I do not have a good read on the market. This is one of those where it's felt like it's just followed the script pretty perfectly. It's like you can just see it coming. Nvidia reporting earnings, the sell-off earlier in the week. It's like, all right, we're going to gap up and then probably sell off. And that's pretty much what happened yesterday. And then on yesterday, we talked about, look, when you have a big puke out day like we did on Thursday, highly likely Friday is kind of a counter trend bounce higher, which we think of, excuse me, as pretty much a dead cat bounce. And then, so today's kind of a throwaway day. And then you sort of, revisit the general thesis on Monday. And so sure enough, as we get to the charts today, nice counter trend bounce, right? So risk assets were up today. Generally, the S&P up about 1%, closing just above 6,600. The NASDAQ, the Dow, all up about 1% for the day. Look at the action in mid caps and small caps, though. Aggressive recovery today with the S&P 600 small cap index up over 3%. The VIX still pretty high, which tells us we're still in a high volatility environment. We should be expecting these kind of severe percentage moves one day to the next. Bonds generally drifted higher today with interest rates going lower. The 10-year yield's now below 4.1%. Gold and silver drifting lower. It's kind of a choppy day for gold for sure. So gold basically finished flat. Gold's been outperforming silver this week, which is an interesting sort of side story. Crude oil price is a little bit lower. Energy was not one of the better sectors. Bitcoin continuing to just be on a royal struggle bus here. We're down, around 85,000 here as we're recording the show after the equity market close on Friday. But all 10 of the top coins tracked on stock charts in the red. As I mentioned, I had a pretty decent Bitcoin and Ethereum position through direct ownership and then through a bunch of ETFs. I've sold most of the ETFs, although I still have some GBTC in a long-term account. I just kind of agreed to not touch that one, but any of the bets I'd been making, based on the strength of the trend, now completely unwound, because I think that is a broken chart until we see some signs of stabilization. I would argue we've not really seen that yet. Looking at the sectors, all 11 of the S&P sectors were in the green today. And again, I don't think that's much of a surprise. I would, if I'm really bullish, I don't know if I would consider today like an all clear sign. It's tempting to think that way. But what you have to remember is in a bearish phase, that's where you'll find some of the biggest up moves. And that's often after a big down move, and everyone just short term feels like a good tactical bounce. But does that really transform this trend into more of an accumulation phase? I think it's too early to say whether that's happening, but consider me doubtful. Materials, healthcare, consumer discretionary are your top three sectors. Those were all up about 2+%. On the downside, utilities, technology, and energy. If there's something to not be excited about, if you're all bulled up right now, it has to be because of the strength in AI, that trade continuing to work through the end of 2025 into early 2026. Technology lagged big time today. That's something to pay attention to. I will be discussing with my Market Misbehavior Premium members a lot more about our market trend model, because it looks like the short-term model did turn bearish on all of the major U.S. indexes as of today's close. The medium-term model on the mid caps actually turned negative as well. Safely still positive for large caps, but we'll be digging a little bit more into that model. Breadth was really strong today. 96% of small caps were up, 94% of mid caps, 80% of the New York Composite Index, 80 to 20. That's pretty good. Looking at the Magnificent Seven and Friends, kind of a mixed day. Alphabet, which has been certainly one of the stronger charts, as has Apple, both having good days today. Alphabet up about 3.5%. Meta up 0.9%. That's been one of the lagging stocks. But the semiconductors and the technology stocks away from Apple, you've got, excuse me, Nvidia, Broadcom, Microsoft all down today. Netflix, which has been a rough chart. And then Tesla, one of the biggest weights, obviously, in the XLY, down 1% as well. Finishing off here, looking at the charts, and then we've got some questions here on an all mailbag episode. 65.50 was our line in the sand. By my read, that is not broken yet. Thursday's sell-off took us just below that. Excuse me, on a closing basis, we are bouncing a little bit off there here today. That's totally reasonable when you test a major level of support to have a bounce. The question is what happens after that bounce, which is why Monday, Tuesday next week, I think absolutely vital. We did dip below 40 on the RSI for most of this week. That's not good. RSI below 40 implies to me we're in more of a bearish range here in terms of momentum. A lot of distribution. Bounces higher on some of these breadth readings, but still overall pretty negative as we go into the weekend. All right, shall we answer some questions? As a reminder, the story of this show has been lots of great questions from people like you. When we've done live events, when we've done the recordings like we're doing on our YouTube channel here, please take a moment and ask a question. Anything that comes up as I'm going through the charts, sharing different tickers and different themes, talking about different indicators and approaches. Happy to answer your questions. I enjoy it a great deal. And these are all questions I've received from people like you just in the last week. Any questions we get in, I'll take a look and hand select some for this Friday episode. Let's get to question number one. Dave, would you be concerned by the divergences in seeing the EMBJ weekly chart? I actually didn't know this ticker off the top of my head, and I know most of the S&P 500 names cold and most other names as well. This is Embraer, which if you fly like, United sometimes, you get a little ERJ, the Embraer regional jet. And I know visiting my daughter in northern Michigan at boarding school, I'll connect through Chicago and sometimes take a little ERJ, sometimes a CRJ. Now I think about the Canadair regional jet up to Traverse City, but Embraer regional aircraft producer. And so the question was, would you be concerned by the divergences in the weekly charts? Let's go to the weekly chart. So, first off, listen, let's celebrate the fact that this stock, it's an 11 billion market cap stock. It's not one I remember looking at in a long, long time, but just look at this brilliant uptrend. And this is what it's a reminder to me. I don't like being caught off guard when someone asks about a stock that is in such a good uptrend, because I want to have found it way back here. Like this is where I want to be finding ERJ or EMBJ, Embraer, and just following that uptrend as long as possible. This is a 40-week moving average, which is similar to the 200-day moving average. So since October of 2023, this has been above an upward sloping 200-day moving average. And it's just a really good, strong, consistent uptrend chart. Your question was particularly with divergences, and I think you're noticing this, right? We're making higher highs in price, but the RSI is not confirming the new highs. So yeah, in an ideal situation, you're making new highs on stronger momentum. And I always like to think of it as, look, if you have two charts and one of them is making new highs on stronger momentum and the other one is making new highs on weaker momentum, I would say then, one making higher highs on stronger momentum is probably the better of the two charts. Again, all else being equal. You want to dig in a little further, but at a surface level like that, that is something I'm pretty comfortable with. Because it just speaks to the fact that one of those is showing lessening momentum, one of those is showing an increase in momentum. And I'd much rather bet on the momentum read from the first one. But both of those are far better than charts that are not going up, right? So charts going up on stronger momentum, probably the best. Charts going up on weaker momentum, not as good, but still good. Charts not going up, definitely not better than either of those two. And so I think that's what I've learned to realize, is that charts going up on weaker momentum, that's a red flag. That's something I want to look for. And we saw that like back here in 2021 on this chart. EMBJ broke above the 150 week moving average. That's here in purple. We're making higher highs into the fourth quarter on weaker momentum. That on its own is not a real bad sign. The lower high that we make here, which creates a sort of head and shoulders top, the breakdown of the neckline, the breakdown of the 150 week moving average, all of those happened here. The sell signals from indicators like the weekly PPO, those are the things on top of the divergence that tell me, okay, this is probably nearing the end of the move. But all these other signs kind of happened after, right? These breakdown signs. So the divergences tell me to put it on another list, which is the price is still going up, but I'm having, some potential issues. So I have one bucket of charts are good, momentum's good, volume's good. Those are like the long and strong up and to the right lists. Don't even worry about those. Then you have another list, which is the price is still going up, but we're seeing some signs to be concerned about. Those are your watch very closely and look for a breakdown. Then you have these other buckets, which are the price isn't going up anymore. And that's the more, I think, dangerous list that you want to make sure that is not much on there, right? Because those are the things you probably want to be unwinding. So that was a long-winded way of saying, yeah, it would be better if this was going up on stronger momentum. I think that would validate the uptrend more. But we've seen plenty of divergences since the end of 2022. And while there have been pullbacks, making new highs on stronger momentum is always a nice resolution to that pattern. So that would be a good outcome on that chart for sure. Love your videos, Dave. What is wrapped Bitcoin? I love the just the 1-2 punch. I appreciate it. I'm glad you enjoy the videos. I'm glad you're watching, and thank you. What is wrapped Bitcoin? I don't know where that came from, actually. I'm guessing because when I show that the market recap and I kind of go through this market overview widget, Stock Charts has the top 10 like most charted coins up here. And it used to be a different list, but then we sort of reflected on what was being asked about, what was being charted the most on the platform, and decided those are the ones that probably people wanted to be asking about. So there's this guy, Wrapped Bitcoin. Here's what I would say. And I'm giving you I'm not a crypto expert version. And what I mean is I'm giving you a version that I hope, if you're not familiar with cryptos, at least this makes some sense. So Bitcoin, Ethereum, Solana, Cardano, these are different cryptocurrency networks, right? Is basically the way you want to do it. It's a blockchain network. So Bitcoin is its own thing. It is a blockchain network. It is a decentralized network of all these different computing systems, all agreeing on the value of Bitcoin and solving problems and logging transactions and confirming who owns what at any given point. That's what Bitcoin is. And Ethereum is totally separate. It's its own thing. And each of these cryptocurrencies has subtle differences in terms of its structure, in terms of how new coins are generated. So Bitcoin was kind of the first one. This was the white paper that was created by Satoshi, whatever his name is, and this mythical person wrote this white paper on here's how we could create a decentralized currency that turned into Bitcoin. But then there have been all these all these new coins that have been created, thousands of them outside of the well-known ones here. So wrapped Bitcoin, by my understanding, is basically a way, if you have Bitcoin, to actually put your Bitcoin on the Ethereum network. And they call it wrapped Bitcoin. They actually do this you can have wrapped Ethereum. There are a bunch of other tokens that are created to allow you to kind of use your cryptocurrency where you have value in one network and put it on another network. And the way that this actually works, if you do it, is you basically, someone's a custodian, you basically deposit your actual Bitcoin with them and they issue you wrapped Bitcoin on the Ethereum network. So wrapped Bitcoin is its own Bitcoin, which basically goes on the Ethereum network. These two should be pretty close, if not almost identical in value, because they're basically tracking the same thing. This is actual Bitcoin on the Bitcoin network. This is Bitcoin that has been transformed to trade on the Ethereum network, but their values are linked up together. So there should be minimal difference between those two. That's what it is. So each of these networks is separate. This wrapped Bitcoin, wrapped Ethereum, which they do in some version with different names for a bunch of different things, are ways to What if I have all my stuff on this network and I want to do something on the Ethereum network? This gives you the ability through a custodian, through someone's help, to transfer your value to a different network. I hope that makes sense. This is not much of a crypto show, I would say. We really focus more on the technology of it, or the technicals of it, not the technology. But I hope that helps you understand a little bit about what those are. By the way, there's a great book called The Business Blockchain, which was recommended to me years ago. I think it's still very relevant, just talking about the kind of behind the scenes. If you want to learn more about those charts that we talk about and what these things actually represent and what the potential is, it's a great book I would suggest. I'll try to remember to put a link in the description below if you want to grab that book. Business Blockchain. Next question. Regarding the NYSE Composite Index, you said you regard it as the most important index, yet a significant percentage of its securities are foreign ADRs, and it excludes the very important NASDAQ stocks. I wondered if someone was going to call me out on that in some way. I actually remember saying that because I say that often. So I'm sure what you're referring to is when I was talking about breadth, right? And so this is the breadth that we talk about often. And so a couple comments on this. I thanks so much for that. It's a thoughtful question, and you're demonstrating through your question that you know a lot about the indexes and their compositions, and I appreciate that very much. So when you think about breadth, when you think about market breadth, what you're doing is you're taking an equal weighted assessment of the conditions of a bunch of individual stocks. Now, what does that mean, right? The S&P 500 is made up of 500. It's actually a little over 500 listings, right? 500 stocks, 500 companies, and tracking the value of their stocks. But it is market cap weighted. So the bigger the market cap, the Microsoft, Apple, Amazon types of size have huge weights, and the very small stocks that are like number 495 out of 500, some are weighted very, very little. They're almost like a rounding error, like it doesn't even have an impact. Market breadth indicators, by definition, are equal weighted. So every stock has one value, right? So if you say 89% of the S&P closed up today, that means 89%, just counting 1, 2, 3, 4, 5, 89% of the 500 some listings were up today. And so that's why breadth is so helpful, because it kind of gets away from that market cap dominance that the price of the indexes is subject to. So when you're looking at market breadth, it can help to look at a broader universe. Problem is, if you're looking at the S&P, these are all mega cap and large cap companies. Same for mid caps and small caps. It's looking at a particular sleeve of the market. The NASDAQ composite, interesting for breadth, but the problem is, remember, the history of the NASDAQ is things that couldn't get listed on the NYSE would often get listed on the NASDAQ. And that, to a degree, still has some truth to it. So breadth on the NASDAQ is always kind of artificially negative, because there's a bunch of junky companies that probably shouldn't be listed on an exchange, but do make it on the NASDAQ, I would argue. And so as a result, the breadth is almost always more negative there. There's a general negative skew to NASDAQ breadth because of that fact. So that leaves us with the NYSE Composite Index. Is it a perfect index, a perfect universe? No. But given these 5 choices, what is the broadest universe that has different sectors represented and different types of companies? I think the NYSE is pretty good. Does it miss things that are listed on the NASDAQ? Of course it does. Does that mean it captures everything? It does not. But is it the broadest group of stocks that I could argue out of this 5? It is. To your point about a significant percent being foreign ADRs, I wouldn't agree with that. Not foreign ADRs, definitely foreign listings, right? So it could be a Japanese company that has a listing on that. That's not an ADR. They actually file in New York, and something like some of the Chinese internet names, right? Come to like Alibaba kind of things, right? Those are listed in the U.S., even though they're domiciled somewhere else. So they're not all ADRs, but it's probably 15-20% of the NYSE of this index are foreign companies that are listed on the U.S. or in some way. So is that part of it? For sure. So, I mean, and this is what I think you would find. The more you dig into indexes and everything, they're all imperfect. It's how imperfect you want them to be, and what is the least imperfect or the most suitable for your purposes. And those reasons that I outlined, that's why I think the NYSE breadth, for me, breadth-wise, is the most important, because I think that gives you a good cross-section of U.S. listed stocks that allows you to understand conditions here outside of the major indexes. Hope that makes sense to all of you. By the way, awesome Black Friday sale happening with Seeking Alpha. They've been a longtime partner to Market Misbehavior, and I'm thankful for that. They're doing a sale right now on their Alpha Picks product, their quant team run by Steve Kress, who I've interviewed on my podcast. They use their quantitative methodology on Seeking Alpha, hand select 1 or 2 stocks every month to highlight as Alpha Picks, and they dive a lot deeper. And I love the opportunity you would have as an individual investor to learn from a knowledgeable group of experts using these models and diving deep into a stock. And I love the educational value. I also love the investment value of having someone highlight some stocks that show promising setups. You can get more information at marketmisbehavior.com/alphapicks. You can scan the QR code that you see on your screen. Use my link. You'll get a great deal. Also helps me make Market Misbehavior awesome. And I would appreciate you checking them out. All right, let's continue on here. I want to learn more about technical analysis. Can you offer any advice on a good book or a way to get started? So I will tell you this. I do have a premium membership. It's called a Market Misbehavior Premium Membership. If you are brand new to technical analysis, that's probably going to be too much for you. So I would humbly say, come back after you've read some of the books I'm about to show you. I often sometimes I'll get people who are like very, very green, just getting started. And I usually tell them, look, you need to go make some mistakes and, try to use some things and struggle through it a little bit. Then come to me with the problems that you've generated. And then I will, I'll move you from like intermediate to an advanced, but I'm not big on beginner to intermediate. I think you need to do a little bit more legwork first. And what I would say is go to my website, marketmisbehavior.com. I have this thing called the reading list. The top 3 books, anyone that ever asks me, what book should I read about investing at whatever level, I say, look, these 3 books you should have read, and ideally you read them regularly. There was a guy, one of my former analysts at Fidelity, who is now the president of the CMT Association, John Kalovis, who's a fantastic technical analyst and has been for many, many years. He would reread the Bible of Technical Analysis, the Edwards and McGee book, which I'll show you in a minute. He reads that every year. These are more of the books that I read as often as I can. I try to read them once a year and refer back to them often. How to Make Money in Stocks is a brilliant, if you're just getting started, that is the first book to read, I would argue, because it tells you about how to value companies, how to value stocks, how to combine those two, and all the IBD methodology you might have heard of. This is the foundation that will help it all make sense for you. Reminiscences of a Stock Operator is a fantastic sort of fictionalized account of a trader in the early 20th century making mistakes, trading and in bucket shops in the Northeast. Things we do today, still the behavioral elements, the psychology, the trading techniques that he talks about there are still incredibly relevant. And I often find myself quoting that book. Manias, Panics, and Crashes. I feel like I'm making an entire career about teaching people how to learn the lessons of market history, how to teach people to, when we're looking at technical indicators, what we're doing is we're looking at what's worked in previous cycles and applying that to the current market. And what Manias, Panics, and Crashes does is it talks about how the boom bust cycle is just a universal fact of human driven markets, right? Going back to, centuries, if not millennia ago, you have examples of euphoria and panic and how that happens. And so what we're seeing now with the AI boom, I think you can relate it to some of the things you will read there. After you've read those 3, I would get down into some of these technical analysis books. And if you're learning technical analysis, the John Murphy book for me was a great introduction. There are a number of really good introductory books. The Murphy book for me, I think, is just awesome. Great survey of different approaches and how to use them. And then every chapter of that book, there were books written just on the content of that one chapter. And there are other things you can go to. And then eventually get into some of these trend following books where you talk about momentum investing, how to structure a portfolio based on those concepts. So marketmisbehavior.com/reading list. Hopefully those are some of the books I would recommend if you're just getting started. Do those, make a bunch of mistakes, make money, lose money, then come back and become a Market Misbehavior Premium member. And I'm going to help you move along in your journey. I always tell people I'm not there to help you start your journey. I'm there to help you move along a little bit in your investing journey. All right, next question. You'd like to talk about RSI readings of 40 and 60. How would you translate those readings into investor psychology? It's a really thoughtful question too. I'm a big fan of when I mean, again, you guys ask some really great questions, and I love when the questions demonstrate some thoughtfulness. And I appreciate you thinking about how do we connect these technical indicators to psychology. That's super important to me. I studied as an undergrad music and psychology at The Ohio State University, and I think the two things that drew me to technical analysis, number one, studying music, I studied orchestral conducting. So what I was studying to do, which I obviously did not go and pursue this path any further, but what I was training myself to do was to conduct an orchestra and stand in front of a group of 100 musicians, try to get them to communicate some emotional thing together as a group. And then you glance down at an orchestral score, which is 15, 20 different parts on these huge pages. And at a glance, you have to look for patterns. You have to look for what's leading and what's supporting that, melody versus harmony. You would have to, based on your understanding of music history, think about what would logically come next because of that period and what the composer was probably trying to do. And when I first looked at a chart with a bunch of technical indicators, it felt like I was doing score study as a conductor, right? It felt like you were just looking at a piece of music and looking down at all the parts and looking for relationships and patterns and using, your analysis of market history. We think about what's logically going to come next. So that was what drew me, I think, to charting. And then when I realized that charting wasn't just a bunch of lines on the page, but it represented investor behavior. It represented psychology, emotions like fear and greed, panic, euphoria, desperation, optimism, pessimism. I was hooked. So any of the indicators that I use, I would argue, have a behavioral foundation. And any of the indicators that I've come across that I think do not really have a good grounding in investor behavior, I just don't use them. They're techniques that people use that I don't, because I just don't feel like they connect appropriately to what we should be trying to quantify, which is investor behavior. This is why I'm not a huge fan of Elliott Wave, but I love the behavioral implications of Elliott Wave analysis. They talk about different waves and the characteristics, the behavior that tends to define each wave. I think there's a lot there. So that was a long-winded soapbox to talk about this. Here's a chart of Apple, and just looking at the chart, right? This is a period here from like mid-April to end of June, where the RSI is consistently between 40 and 60. And what I think, for me, that means a market in equilibrium. What RSI is actually measuring, the relative strength index, is an indicator created by Wells Wilder in the 1970s. Basically looks over a period of time at the average up day versus the average down day. So when we close higher, how much higher do we tend to go? When we close lower, how much lower do we tend to go? The RSI is basically a ratio, the average up day versus the average down day. Then there's some exponential smoothing and other stuff to make it look pretty, but at the core of the indicator, that's what it's actually measuring. So if the RSI is at the middle at 50, or I would, sort of broaden that and say, if it's revolving around 50, so if it just sticks between 40 and 60, that would represent equilibrium because up days and down days are pretty even. So without even looking at the price, I'm going to guess if there's a period where the RSI is just sitting between 40 and 60, that's probably generally a sideways trend, like an equilibrium. Buyers and sellers are in agreement, no strong momentum on one side or the other. And we can see like May and June, that's pretty much what the price was doing. Like here in August, September, October of 24, prices kind of going sideways. But then also tells you that when the RSI is, doesn't get above 60, but also gets below 40, then the whole range is lower. And that probably means we're in a distribution phase, a downtrend phase. And when the RSI becomes overbought and doesn't get below 40, then the whole range has gone up. So we have a bullish range, everything above 40. We have a bearish range, everything below 60. We have a neutral range sitting between 40 and 60. And whichever one of those three describes the RSI at any point, that will tell you pretty much the primary trend, or at least that's how I think of it. So again, without looking at the price, I can see that there is this period in March and April where the RSI is in the bearish range. Then there's this neutral part in May, June, where we're in the the bearish range. Here we're in the neutral range, and then July through really November where we're in the bullish range. And then looking at the price, that makes sense that that's what the price action is. So between 40 and 60, I think that's a neutral kind of equilibrium type of period where buyers and sellers are in agreement. But what I love about your question, and I would wholeheartedly agree with the implication of your question, is that indicators matter. They mean something because they help you quantify investor behavior, right? And that's how I would think of that. All right, final question. Then we'll call it a weekend, and I'm going to go have some more tea and try to relax and recover here. Can Visa and MasterCard charts be considered as trendless and range bounded? Well, perfect segue, because we just talked about that. Let's see what we can see. So start with the chart of Visa, right? So let's start with the point I just made. Where's the RSI? So the problem is, I would say for like July, August, September, equilibrium, RSI between 40 and 60 pretty much the whole time. All of a sudden, the month of November, particularly in the last week and a half, RSI has gone below 40. So I would say at this point, this is now a chart in distribution, no longer in an equilibrium breaking down. I think you could say, and just looking at the price, right? Could you say this is in an equilibrium? Another way to kind of figure, are we in an equilibrium, is like draw a rectangle. And if the rectangle kind of captures most of the price action, then that's a sideways trend, right? Look at all of these lows right around the same place. Look at all these highs right around the same place. RSI between 40 and 60, but then something's new, right? We break below, we make a new 3-month low. RSI breaks below 40. For me, that's like a big moment, and suggests we're probably going a bit lower. MasterCard, same thing, right? Back here, we're kind of between, 40 and 60, but very quickly we actually went below 40, and we're not getting even getting above 50 on these rallies. So I think MasterCard almost skipped the neutral thing and went from a bullish momentum range to really a clear bearish momentum range, which is where it is here. Both of those charts now, and MasterCard even worse, making a clear pattern of lower highs and lower lows. That is a classic downtrend pattern on weaker momentum. So for me, no, I would not be considering them trendless and range bound. And sorry, I had the question covering up the chart there for a while. I would not consider those range bound anymore. I think both of those unfortunately have broken support. And MasterCard probably the worst of the two because it broke the 200-day, tested it from below. Lower lows and lower highs are not bullish. Folks, that'll be a wrap here. I got through the show without pausing for a cough. So that's hopefully that's a great sign of recovery, and I will hope to recover all weekend and be back in better than ever on Monday. Have a great weekend. Expect an adjusted publishing schedule. I haven't really thought about next week yet, but I will most likely have shows early in the week, take the rest of the week off for Thanksgiving, and wish you guys, those of you in America that are celebrating Thanksgiving, wish you a thankful and restful and joyful Thanksgiving holiday. Have a great weekend. We'll be back with you on Monday. In the meantime, remember, it's always a good time to own good charts. Take care, folks.